I realized I didn't really define ergodic and non-ergodic quite clearly. The easiest way we think about it that's very visceral is if you think about Russian roulette, right? Would you rather be one of 6 people playing Russian roulette, or would you rather play Russian roulette 6 times in a row, right? That's the difference between an ensemble and an individual path. Like
Really not.
if I offer you $1,000,000 to play Russian roulette once, you shouldn't do it, but you might think about taking it, right? But if I give you $1,000,000, but you got to do all 6 at the same, like in succession, you're not going to take that shot. So that's the difference between that means it's non-ergodic when your individual path dependency is different from the ensemble average.
All right, all right. Welcome everybody to another episode of Resolve Riffs, and this time we have the one and only Jason Buck, CIO of Mutiny Funds and co-founder of Mutiny Funds, master of all trades. He is a galaxy brain that we always tap into whenever we have any thoughts on pretty much everything. But today we're going to focus a little bit on our area of expertise, which is investing. Jason, been a long
Not
time, man. How are you
necessarily.
been? Not necessarily. Sure. We can go Bitcoin if you want.
I thought we were going to talk about I thought I was here to talk about keto, VO2 max, that sort of thing, and apparently you guys shop at the same, couch outlet for the color of your guys' couches in the
Oh,
background there.
God, don't get me started on that, but yes.
Not
Funny
probably not a
story
lot of
about that we
choices.
will not get
Yeah.
into.
How you been, Jason?
Couldn't be better. I actually, I didn't mention while we were off air. I was actually last week. I don't know if either of you guys listened to Founders podcast with David Senra, but he did an event last week for founders only in Austin, Texas, and it was really cool to meet, 100 other great entrepreneurs that are big fans of the podcast, and everybody was kind of doing their own thing. It was nice because like David had vetted them, so it's on kind of a high from that, and then kind of crashing over the weekend after all those intense talks. It reminded me of like some of those the collective events or Real Vision Blacklist where you're in those
Yeah.
intense conversations like 24/7, which is it's really exciting but really exhausting at the same time.
Oh, yeah. Day 1 is amazing. Day 2 is pretty good. Day 3, you're like,
Yeah.
"How do I hide in the corner
Exactly.
and not get cornered?" Yeah, I remember those. It is draining, right? And you're sitting around people that aren't just first derivative thinkers, they're second and third derivative thinkers, so you can't just, go at it half-assed. You have to be fully engaged in those conversations.
Yeah, that's
Otherwise.
the joy of the privilege that we're in positions in a lot of times, whether it's in hedge funds room or with other entrepreneurs. I love being in those rooms where like you have to really mind your P's and Q's. Like when we're sitting around having a beer with like the in-laws or some of your buddies, you're just kind of shooting the shit. You could throw out some macro opinion or some political opinion, and everybody just lets it fly. But in those rooms, somebody's like, "Excuse me, I happen to be an expert on that," and then they deep dive and just crush you. And so I always love being in those kind of rooms.
Oh, the worst feeling is a head tilt as you're delivering something with a guy
Yeah,
that brilliant in that space. You're like, "Oh, here it comes. Here
exactly.
it comes." Yeah, well, it's almost like every day with Butler and Philbrick, honestly.
Well, that's why, as you know before, I said I was raised in the cauldron of Gen X, just beating the crap out of each other growing up, verbally and physically. So yeah, I'm well used to the kumite.
Indeed. So what have you been working on these days? Because I think, honestly, Jason, since the day I've met you, we've always basically said the same thing in different ways when it comes to the investment side. But I was reading one of your blog posts recently that I thought was quite insightful in terms of trying to explain, I guess, ergodicity. But why don't you walk us through the Herschel Walker analogy that you guys wrote up recently?
Yeah, this is a great essay written up by my partner Taylor Pearson. But the thing like that Rodrigo's alluding to, we talk about ergodicity a lot, and it's just a fancy word for sequencing risk or path risk, right? That we've kind of always heard about before. But we try to attack it in many different ways, and a lot of times people use sports analogies. But Herschel Walker was actually the Herschel Walker trade was known as the Great Train Robbery. Now, I know Phil Brick's not on here. You guys aren't big, American football fans, but
Mm.
basically in the 80s and 90s, Herschel Walker was a great running back. And when Herschel Walker first came out, he was drafted by the Dallas Cowboys. And, over his lifetime achievements, he's got Hall of Fame numbers. He put like up over, I think, like 8,000 rushing yards, close to like 5,000 in receiving yards. And this was a time when running backs didn't really do receiving. So he was really this multi-tool player that people thought was a true game changer. I think he had about like 61 touchdowns ish. So, he plays for Dallas for like 3 years, is absolutely crushing it. And the Minnesota Vikings think, we need to get Herschel Walker. This one player is going to change the fate of our organization. And now we're going to win some Super Bowls. So in the trade for Herschel Walker, the Dallas Cowboys received, if I recall correctly, 8 draft picks and 5 players for one player in Herschel Walker. And it was like 3 first round draft picks, like 3 second round draft picks. It was pretty insane. So Minnesota Vikings get Herschel Walker. Turns out they kind of top ticked him, unfortunately for him. And after 3 years, they traded him on, I believe, to the Eagles, and then they traded him on to the Giants. So it's kind of, he put up those great numbers the first years, and kind of like languished a little bit after that. And they call it the Great Train Robbery because of the amount of players that Dallas got. But more importantly, they went out right in that next draft and they got players like Emmett Smith, and they were able to. This is 1990. Basically, the trade was 89, and then the early to mid 90s, the Dallas Cowboys used those trades to build a team that won 3 Super Bowls in the early to mid 90s. So that's why it's called the Great Train Robbery, because it was the most lopsided trade in history. Basically, one player for eight, and Dallas was able to win 3 Super Bowls while the Minnesota Vikings were not able to pull it off at all. So it's just an example of, I know, we started the beginning of this, referencing being in these rooms at global macro events or entrepreneur events and everything. And you guys have seen it a million times. Everybody's like, what's your number one trade? Whether it's the Sohn conference, whatever. Everyone wants to know, what's your number one trade? What's your number one asset class? Show me how to make a fortune off of one trade. And as I know, you guys don't think that way either. We think in teams or ensembles or portfolio construction, because it's more important, like, what if you're wrong? And it's more the average return across that team than any individual trade or individual strategy or individual player. But it's a mistake that we see time and time and time again. And we could use millions of different sports analogies. Like, I've been working with on the idea of Tour de France, which may be more in your either you guys cyclists. I know you're swimmers, not cyclists, right?
No, no. Other stuff,
Okay.
runner,
G-
you know,
Got it.
Gaelic
You haven't.
football, but that's not
I feel
cycling.
like we can
I know
track
of
them.
it.
Keep
I
going.
followed enough of
You
it
could.
to
Yeah,
type
yeah.
in.
You could track it. I mean, I know you'd love to, put on those uniforms and get in your full spandex, and that way you could be a
Oh,
team
that's a
billboard like the
different
rest of them. Yeah,
Only in the
like,
exactly.
privacy of my own bedroom.
It's yeah. I always love in Napa Valley, always we see these guys all completely dressed up, right? And the new bike these days is anywhere from like 25 to 50K for those bikes. And then they're in full team gear. And I'm like, are you a domestique for Lance Armstrong? Why are you represent like it's just amazing. It's a dress up for all these rich guys to pretend like they're cyclists with their big beer bellies. It's great. And I'm sure you guys have seen this stuff about, bone density and everything. It's like being in space or something. It's a terrible way to get exercise. Plus, you end up
yeah,
like a T-Rex. Anyway,
yep.
the Tour de France
Check.
20.
We can talk about you wanna
Yeah,
talk about that? You wanna do a half an hour
yeah,
detour on that?
absolutely. That's what I thought. We were here for VO2 Max. So there's 21 stages of the Tour de France. What's very interesting is the yellow jersey winner, the overall category winner, a lot of times may not win any stage or just a few stages, but it's the person with basically the best time or the best average speed over those 21 stages or 21 days. Lately, now they're up to 42 kilometers an hour, which I believe is about 26 miles an hour is kind of the average speed to win the Tour de France. And during even that time, there's been two guys that won the Tour de France that didn't even hold the yellow jersey at all to the very last day. So once again, it's about your average time. And if you think about Tour de France, you have the flats for time trials, you got a little bit of hilly things for sprints, you've got the mountains of the climbers, and there's different jerseys, whether it's polka dot, green jersey, white jersey, for people that can win those stages. Because as a overall winner, you have to be well rounded, right? You have to not lag too far behind on those sprints, not lag too far behind on those mountains. Make sure your team can really put up great numbers in that time trial. So you have the ability to, once again, it's your average ensemble through time. It's that multiplicative process that we always talk about day by day. How can you do multiplied by the next day, multiplied by the next day? And that what ends up with your Tour de France winner, and you don't have to be really outstanding at any one particular side. And then it's fractal in nature too, because you have a team with you. All these domestiques are the ones that are trying to,
I was gonna say.
maybe, yeah, you can ride behind them to get a little bit of a windbreak, to kind of rest during those tough times, pull you ahead. They can chase that peloton down for you. There's a lot of things that are going in that fractal nature of everything we talk about with ensemble approaches to investing. It just takes time and that multiplicative effect to really win that championship. And we view the same thing. When it comes to investing, it's offense plus defense wins investing championships for
And
us.
and I think that's a key point here because we talk a lot these days about line item risk. And if you
Yep.
think about each one of those teammates within the Tour de France, when you actually there's a great I think it's on Netflix, maybe it's on Prime, but they follow the Spanish team
Yep.
and talk about how they're dealing with the different stages and how important it is to have your anchor man to be able to be at the top when because you have your lead guy exhaust himself in the previous run. I mean, it takes a few days to recover from that, your hemoglobin count and all that, technical stuff. But the point is that you are going to be a loser after being a big winner, necessarily physiologically. And you need your number two and your other players to play integral roles. And if you are a typical investor and you're looking at these cyclists and deciding whether to invest, quote unquote, in them at any given time, you might be culling the best cyclist if you see them underperform on the third piece of that tour, right? So this is what we see all the time. You see the idea of an ensemble makes sense. Then you put the ensemble and you get each individual line item, each individual name. They have a poor period. You call the worst performing. You give more money to the best performing, and it just creates a lopsided distribution. Right? It's a problem. And yeah, I think your board analogies, both of them, bring light, try to say the same thing in different ways, that the real goal here is to minimize the team's distribution of outcomes and maximize the chances of success. So I love that cycling analogy.
Yeah, the
Chris
one
Cole had a really
good.
good similar analogy, right, with Dennis Rodman and the role that he played with the Bulls for so many years. And I just love how it highlights that you can have a player who is just so unbelievably potentiated or synergizes so beautifully with a group, a certain group of people that all complement that player in different ways, or that player complements them in different ways. Together, they are much, much bigger than any of them would be if they were to, be a diaspora that all went to join other teams, right? Together, they are something much larger than the sum of the individuals. And, I don't know the Tour de France nearly as well, but I imagine that that entire team is what wins the championship. It's not the guy who passes the end line first, right? And similar with Dennis Rodman, clearly a very you know, niche player, had a very specific role that he played on the team. He got rebounds and he kicked it back out to provide new scoring opportunities for the other members of the team. He didn't score much on his own. He didn't have a lot of, he's a pretty good defenseman in general, but didn't have a lot of great offensive qualities. But without him, they would have had far fewer opportunities for the other members of the team to score. And, if you look at your portfolio in the same way, you can't really in any way determine the value of any of the constituents of the portfolio outside of the context of the portfolio as a whole, right? I think that's very, very challenging for many people to recognize, and it makes the decision making hard because now you're making decisions in a multidimensional context, not in the context of is this manager good or bad?
And what's challenging, and I'll ask you a question here, Jason, is in my experience anyway, when you talk to people about the different components and then you let them see those different components in their portfolio, they have a tough time with it. And we often get a question, it's like, why don't you guys just wrap it all up in a single, like a one shot solution? And I would say, because then nobody understands what's going on. That nobody wants the one and done solution, because it's really, you want to know what's going on underneath the hood, and it's so non-correlated to S&P 500. So you straddle kind of that. You talk a lot about diversity of strategies, diversity of managers, but you have a lot of or one and done solutions. Like, how do you think about that problem with investors?
Yeah, it's the thing that, as a group, we've been talking about for a lot of years now. And so, like Adam was saying, like with Dennis Rodman, if you're looking for players that score, right, you're never going to pick a Dennis Rodman. But if you look at his offensive rebounds specifically, and then you look at Scottie Pippen and Michael Jordan scoring, it's much higher with Rodman on the court. And similarly, like soccer, like Liverpool got great because they got Alisson as a goalkeeper and then Virgil van Dijk as their sweeper, right? And now they could go all out high octane offense, and then they start winning championships, right? Because it's that combination. But a lot of people have read Dalio and that 16 uncorrelated return streams. But as we've always talked about a million times, especially it's not just uncorrelated. If you can get negatively correlated return streams, that's incredibly accretive to the portfolio over time. Now, individually, if you look at that snapshot and that negative line item risk of, say, tail risk hedging protection, it looks like a terrible negative line item. We've talked about how do you get over that hurdle in many different ways. And whether that's, zigzag zog, like we've talked about, you guys talked about skis and bikes was, I always bring up your guys' great example from back in the day. Is how do you put those together? So the way, like you said, I think about it is, if anybody wants to see our line items, we're full open Komodo. I like to show all that stuff. But more importantly, you have to get investors buy-in. And so you have to meet them where they're at. And so part of that is like we started at a very high level, just offense and defense. So we describe offensive assets as everything that people know that's like long GDP from stocks, bonds, private equity, VC, real estate. All of those things are offensive assets in our mind. We then might like to pair those with defensive assets like long volatility, tail risk, commodity trend following, gold, maybe even cryptocurrency. We can argue about that later. Other people can argue about that. But the idea is like you need to pair offense plus defense. So that's the way we started about. And then other ways of thinking offense, defense, if you want to get more sophisticated, is implicit short volatility trades versus long volatility trades, or breakout versus mean reversion. And it's about pairing those kind of things together and how the portfolio compounds through time. So we like to put together tons and tons of line items to get that uncorrelation and that negative correlation, but it really basically boils down to offense plus defense, right? And that's what we kind of paired together in our cockroach portfolio. And then, like you're saying, Rodrigo, we allow people to pick, if they just want the defensive assets, that's fine. If they just want the long volatility, that's fine. If they just want the commodity trend, that's fine. But then within that, our Mandelbrot and fractals, we like to then use ensemble approaches to even those different asset classes. So we're just trying to get that broad diversification because we don't believe we have a crystal ball or can predict the future. So I think it's a combination of both. It's, to get the emotional buy-in, and we've talked about this many times when you're dealing with clients. If you can't get that elevator pitch emotional buy-in, to like offense plus defense, then all your line item risk doesn't matter. And so you are right. I think if you could package it up into a one product fits all or a total portfolio solution, I think people do a lot better just seeing that total portfolio solution and their let's call it their monthly returns on that than they would seeing the line items. Cause like you said, then they're gonna nitpick those. Like I know Rodrigo, you're intimately familiar with there was a famous tail risk manager that they developed a product in Canada that added tail risk. And during
Yep.
the good times, people hated seeing those negative line items on there. And I think it closed down after like 3 or 4 years. So it wasn't even didn't even get a chance to live through the first like black swan event. So it's really about, I hate to be, it sounds pedantic to say it's a form of babysitter tax, but by combining those things into a total portfolio solution and just getting your clients to hold those, it's much better to figure out a way for them to hold those defensive assets so they will be protected. And those things can kind of jump out of the curtain when they need them most, either during, a liquidity cascade, TM to Corey Hosteen on that, or, like inflationary environments where you need those commodity trend followers or some sort of, fiat, default diaspora valuation where you need those gold or potentially cryptocurrencies. So it's about, combining those in a way that people need the most. But then if people do want to deep dive, we're more than happy to show them all the line items.
So in the mutiny fund, allow people to understand what they're holding. And I guess that's interesting because I wonder if that's behaviorally different. The idea that, hey, you can look through the window, but you can't touch, right?
The
This is
flip
not your
side,
portfolio.
the
You can
flip
look through the
side
window,
of
but you
that,
can't touch. It's your portfolio, and you can be like, yeah,
Yeah.
this is all generally good, but can you take that one item out? Like, if you can't do that because you're in a pooled fund, yeah, look through the window all you want. I am not selling that fund manager that is down 3 years in a row.
Right. So it's not and sorry, Adam, I'll let you go, but like it's not a choose your own adventure. Yeah, we don't let you mix and
right?
match kind of in the portfolio. You get what you get. And I steer 99% of our clients to the cockroach portfolio because it's just better for them to hold that long term. They're much more likely to hold it with all those asset classes in there. And then quite frankly, there's 10,000 hedge funds out there and even more, ETFs, mutual funds. If you don't like, our particular brand of putting those together, there's plenty of other options for you. So it's like, yeah, kind of like you said, it's like, you can get any color Model T Ford as long as it's black kind of thing. And that's the way we do the cockroach run. Sorry, Adam, go ahead. Save me from myself.
I was just gonna say that it is funny because you know there's so much advantage to wrapping all these line items up into a single return stream, and then of course clients always want to look under the hood, and there is some benefit because usually if you've done it properly, you've got something that you can point to or that they can point to that is working, right? So there's going to be some equities in the portfolio, equities are rallying. You can kind of say, well, I mean, you own some equities, right? You're not all entirely equities. So at this point in time, you're dragging a little bit relative to some arbitrary benchmark, but there's something there, the line item there that's delivering this excitement that you're hoping for, right? And then there's these other line items that are not shining right now, but that we expect to shine under different market conditions. And so they can, they've got something to root for, even while they're enjoying the slow and steady rise of the diversified portfolio.
There's a flip side though to that too, Adam. Like there's something to cheer for and then there's something to hate, right? And we always try to, educate our clients that like there's always a part of the portfolio that probably makes you want to throw up, that all the news media is telling you not to own. We've talked about this a million times, but bonds the last few years, nobody wanted to own bonds, right? But it's part of a broader diversified portfolio. And quite frankly, if all your asset classes are up and to the right, you don't have broad diversification, right? Like you need something you hate in that portfolio. So it's really about educating clients, making for sure you find the right clients. And I think that's the more interesting piece to what we all do is trying to find your tribe, right? And I spend a lot of my time trying to fire clients as they come in because if they're hot money and they're looking for the hottest thing, they're just not the right clients for us. We just have very different time horizon and perspectives. And that's fine. I'm happy to pass them along that somebody be a good fit for them. But a lot of times, most of the time we're not a good fit. So, it behooves us to spend our time on the clients that have been searching for what we do, have tried to build themselves, are looking for a solution like what we have, and that understand that broad diversification means, if you're benchmarking to 60/40, which is an arbitrary benchmark, you can be above or below that given any month, quarter, year. And then, like you're alluding to, Adam, as we all know too well, it's great that like, especially this year, each month is different. Like, one month, stocks are up and you're like cheering, and then you rebalance at the beginning of the month, and then bonds are up, stocks are down, commodity trends going up and down, and you're getting this broad diversification. And then even more granular than that, we use global stocks and global bonds. And quite frankly, it's been a pretty shitty 10-year run for global diversification. But we just feel that's the right thing to do long term.
Yeah. And, it's, I tend to speak about these strategies, these all weather, all terrain strategies, cockroach strategy as multiple pistons in a motor that you want to have because they're going to move up and down in different times in different ways. But if you have them in balance, you're going to have a well balanced motor. Um, and oftentimes, I think people think non-correlation means, well, each one of these is going to have negative correlation to each other. So when most definitely there's going to be you're going to have your non-equity bond exposures be completely non-correlated and always making money. But there's no even at any given day, any given month, you can see a possibility if you have 8 different pistons of 7 out of 8 of them being down, right? Or like if you just think of the major components of a risk parity portfolio or the all-terrain portfolio, which includes trend following that we've written about, you have 2022 where you see, let's say, equity and bonds, 2 pistons down, trend and commodities, 2 pistons up, making a 0 return. And that being a great year for a cockroach type portfolio, right? Like when you didn't lose 25%. And then the next year, the 2 that went down went up, and the other 2 that went up went down, and you're kind of ish, like flat-ish, you're offsetting each other. This can happen for a prolonged period of time in an all-terrain portfolio. But I just think I wonder whether the nomenclature, I like cockroach better than all-terrain or all-weather because it feels like cockroach is about not dying and all-terrain is
Yeah.
about winning all the time. And I think that's where the disappointment comes. Have you found, in the last couple of years has been one of those periods where half the pistons have been down and the other half have been up. Have you had difficult conversations about the resilience of a strategy like this?
Yeah, I think you're always
The
gonna have those
effectiveness?
different those difficult conversations in the interim, right? Because it's hard. As you know, in this industry, we can look at a 20, 30-year back test and, back tests are caveat emptor and, future performance is not indicative of past returns, right? Unless to me you build really broadly diversified portfolios like we all do. Then you can have a better intuition pump that this is a little more accurate than probably just a singular short ball strategy, right? Like it just hasn't seen the blow up yet. So that gives me at least some confidence in what we do. By the way, I realized I didn't, really define ergodic and non-ergodic quite clearly. The easiest way we think about it that's very visceral is if you think about Russian roulette, right? Would you rather be one of 6 people playing Russian roulette or would you rather play Russian roulette 6 times in a row? Right? That's the difference between an ensemble and an individual path. And an
Wait,
ergodic
finish it.
system,
Oh, good.
yeah. So
That's
so an
okay, 'cause I
ergodic
just like
system
to
is where the
spell it out
ensemble
to
is,
people.
yes, the ensemble's
You're
the same.
dead,
Yeah,
guaranteed in one.
exactly. Exactly.
6
Like
barrel guy.
if I offer you $1,000,000 to play Russian roulette once, you shouldn't do it, but you might think about taking it, right?
That's how
But I've
desperate you are. You might do it. Family's
right.
hungry. Maybe it's like, it's a period of starvation. Everybody's trying to get along and have some
Yeah.
fun. If I die, if I get it, my family is set for life. I might take that one shot.
Right. But
But
if I give
how
you
often am I going to do all 6 barrels?
exactly, but if I give you $1,000,000, but you gotta do all 6 at the same like, in succession, you're not gonna take that shot. So that's the difference between that means it's non-ergodic when your individual path dependency is different from the ensemble average. And this is where I think expected value gets people caught up a lot of times, and they don't think about expected value in a portfolio construction construct. And so, that's why we think about most of our life, the more interesting things in our life are non-ergodic. So that's the way we try to think about, hedging out some of that risk and trying to have those tighter bands of expected value and probabilities multiplied together, over the longer term through broad diversification. Like we were saying with backtest, you can have a better, hope for that. But yes, I think in to answer your question, people have questions all the time. Like people question why we held bonds for a long time, and like we said, maybe one day the bonds will come back. Maybe they won't. We just don't know when. People, hate having long volatility and tail risk until they really, really need it. Then they love having it. I'm sure when stocks, eventually tank off, people are going to hate owning stocks. And then commodity trend comes and goes out of fashion. So these are the kind of life we chose to live. Is we like to beat our heads against the wall with this broad diversification, but I think more importantly for all of us, it's not there's no way for us to even think or live any other way, right? That's the way we think about the future because I don't have a crystal ball. I can't predict the future. If I could, then I would be able to tell you what asset class is going to do great over the next 6 months. But I don't think anybody possibly can. And so that's why the other primarily clients we work with are a lot of entrepreneurs 25 to 45 that sold their business, had their first liquidity event. And like I always try to tell them is like, you had to take enormously concentrated risk and you had to get enormously lucky to make that kind of wealth. Now, to keep it, you're going to need broad diversification to preserve and keep that wealth. And for a lot of people, that's a very difficult 180 to make. So, going back to your thing about explaining what we do or trying to get it across to clients, I think it's more important to get these simple things right. Make it very simple about broad diversification preserves wealth, about offense plus defense preserves wealth. Those sorts of things. If you can't get that, it doesn't matter about the line items. It really doesn't.
So I had an interesting discussion with a very wealthy individual who I like. I'm going to use that analogy actually. Like you played roulette, you played it once though, and you
Right.
got lucky. And if they like had a couple of failed attempts, like you played, you got shot once. Your wallet was dead, and you had to come back to life in order to play again. But now we want to have a more consistent rate of return. But I was talking to this very wealthy single family office and discussing this concept of you don't want to lose it. Now, his view was, "Oh, no, I have enough to live off of no matter what. Like, I don't need hundreds of millions of dollars. So with what I have left, I should go balls to the wall." What do you guys think about like, how do you respond to that? And what if you're actually giving proper advice to somebody who's got $200 million and that person lives off of $500,000 a year, what's the better advice there? Is it to keep
Well,
it
I'll,
or to
I'm gonna
go
I'm
or
gonna
to go all in?
I'm gonna jump in before Adam. I was about to say, like, now that you put a figure on, I was about to say, I do know a guy that has $1 billion in T bills and lives in Puerto Rico and no taxes on those T bills. So he can live off of that and he's got plenty more on the other side for him to go balls to the wall. So it really depends on scale. That's what what is it, Danny Kahneman, utility theory, utility maximize. It really matters, what your nut is, what your living expenses, all those sorts of things. So I can't really say what somebody else should do. But what I do think is interesting that nobody brings up is going back to these naming conventions of like we use cockroach, you guys use all terrain, Ray Dalio used all weather. By the way, Ray, you crushed it with return stacking. I think you got to work on the all terrain. So like that. And by the way, everybody told me not to call it cockroach. Everybody's like, don't do that. Everybody's going to hate that name. And I'm like, will you remember it? Right. Because we know how many people have these terrible names, like 3-letter acronyms that we can't remember any of them. But it's just about, like you said, survive anything, you'll remember it, those sorts of things.
Yeah.
But getting back to, what you can live off of. Oh, when Harry Brown came up with his permanent portfolio, which I think all of us are doing a somewhat derivation of, because Harry Brown kind of came up with a 4 quadrant model that
With what you
Valiant
could
collaborated.
invest in at the time, yeah.
Right. At the time in the 1970s, he came up with the 4 quadrant model that we always talk about on the axes of inflation and growth, and kind of how that Venn diagram overlaps. But what people forget is Harry Brown also had his variable portfolio. So he's incredibly smart. He said, look, put 80 to 90% of your assets in this permanent portfolio that can kind of trundle along in any macro environment. And then he's like, I know you're a human being, so you're going to want to take flyers on specificity, or like things that you think are going to take off in individual kind of bets. And so that's your variable portfolios, like 10 to 20% of like your fund money, but you can't replenish it from your permanent portfolio. But I think that was a really interesting thing that never gets brought up. People bring up Harry Brown's permanent portfolio, but they didn't bring up the variable portfolio, where he really took into account human psychology and our ability to want to bet, to want to tell our neighbors about our wins. Now, conveniently, we forget to tell them about our losses, but that's how we like to live in every day in the real world. Sorry, Adam, your take. Can they
What
take
are
the
your thoughts
flyer?
on that?
Whenever someone asks a question like that, I always think of the movie Heat. Do you remember Wayne
Yes.
Grow in the movie Heat?
Yeah.
Right. And not Pacino, De Niro's character says, you know, you've got plenty put away. You don't need this job. Um, I recommend you step back. And, he considers for a second. He says, for me, the action is the juice. And, I think that for some guys, the action is the juice, right? Like, it's not about putting money away. It's not about having a safety net for future generations. It's not about um, wanting to give it away to causes you believe in. It is the action is the juice, right? So it's going to really depend from person to person what they want to do with that wealth.
Well,
But
like you
from
said,
intellectual sorry, Jason, go ahead.
no, I was gonna say, you guys are trend aficionados, so you may remember like the old Ed Secoda quote that like everybody gets what they want out of the markets, and
Yeah.
most people
Yep.
want the juice, right? Like it's just like betting on the ponies or whatever it is. Everybody wants some juice, and there's another great movie that you've guys seen, The Gambler with Mark Wahlberg, and they in that he's like,
Maybe years ago.
it was like, I can't remember the exact numbers. Like anybody gets up 2 to 5 million, you know what you do? You buy a house with a 50-year roof on it. You pay it off free and clear. You buy a Japanese shitbox car, and that's your fortress of fucking solitude. And you put like $1 million in T bills. And he's like, any idiot that doesn't get that fortress of solitude before he wants the juice, that guy's the moron.
Well, look, the way I see it, I love that, by the way. But I think everybody wants the juice, but do you also have to take the risk?
Well, I don't
Can't
think
you?
everybody wants the juice.
No, no,
I
no.
think
But
lots
but
of people
I see
don't.
people that tell me that, where they say, "Look, I got X. I want to go for I want to maximize my returns." They're not really willing to put in hundreds of millions of dollars into a single like small cap company. What they're saying is, I want to put it in all equities. Right? They're put it, or private equity, mostly private credit. Like they like the idea maybe of being the insider. But what bothers me about that concept, when we're let's set the table. We're talking about people who are still investing in equities that on average will have a volatility of 15-20%. If you're doing privates, maybe in reality your volatility is 20-25%. That you're still better off with a well-diversified portfolio if you have access to cheap leverage to get you to that same level of risk, right? If the Sharpe ratio of an equity portfolio going back to the uh, 100 years is 25 to 30 basis points, right? So if you're taking 20 units of risk, you're going to get 6 units of return, if that math is correct, right? If I can put together a portfolio that gives you 60 units, 60 Sharpe points, then you're going to get the same return for half the volatility. Why wouldn't you take that bet every day? If you can indeed get access to enough leverage to get you there. And I think most people at that level will be able to, and nobody's walking them through that. I just don't think it exists.
Well,
Well,
There's no reason not to do that. If
I don't
you
know because I mean, you
want,
and I have observed this for many years that we'll go through the presentation on diversification means diversity plus balance, go through the different economic regimes, go through how the different assets and strategies are fundamentally designed to respond in different ways that are highly complementary. Everyone's nodding through each of these slides. They're, just is the most obvious thing in the world once you show it to them. And at the end of the conversation, when it's time to, okay, great. Yeah, how should we move forward on this? Well, I'll get back to you, because the reality is there's a number of different objectives that they're trying to meet. One of them is, well, I don't want to look silly and do something that's different than my friends because this might not work out. Or, well, my friends are doing might work out way better than anybody anticipates. Now I'm way behind. Um, I want stuff to be able to talk about with my friends at dinner parties. Um, I personally really like stock picking. I get really excited about new fundamental trends and love the excitement of being part of that. Like, there's just all these different dimensions of objectives for participating in markets. I'm going to go out and say probably a minority fraction of those motivations have anything to do with wealth maximization or utility maximization. Most of them are driven by the limbic system. They're often very status oriented. And so, while stuff makes sense to the prefrontal cortex, so all the rest of their brain is totally asleep as you're going through all this and getting the nods.
It's
Well,
a
as
Meb Faber hoops, always tapping hoops and saying, "Hey, whenever you're ready, fire everybody. We can just do the ETF portfolio that's basically 99% correlated to yours, but without all the employees and the fees." I love that. Right? He applied
Yeah, it's like
as a
I'm going to
CIO.
come back to this once I've tried and failed at everything else. But I've got to try and fail at everything else
Yeah,
first.
what's the motivation for hoops to continue to do not pay attention to Meb's suggestion?
we love
There's other
complexity,
motivations.
but also like as I told Adam once, you never go full quant. Like, Rodrigo, you never go full rational when you're trying to do sales, right? You're trying to show these rational layouts, and this is what you guys do also well. But people buy into emotionality, right? And it's not really sexy, and it's not really that emotional. And that's maybe when it comes to, you know, closing the sale, it's difficult when you're doing something so different, right? Like, so if everybody else is like doing 64, like Adam said, and all their neighbors are, or trying whatever they're doing, or chasing these different real estate deals, whatever, they want to be like their neighbors, right? They like to keep up with the Joneses or be similar to have, or like you said, to have something to talk about. Not a lot of people are necessarily just as disagreeable as Adam and I are, right? Like they like to agree with their friends and neighbors and have fun conversations and not say excuse me, I've be that turd in the punch bowl at all the parties. So I think that's a big part of it. I think the other thing is, like, if somebody's got that kind of money, like we said, that concentration risk. If they can sock away, even if it's only $10 million into something that's much safer, whether that's T bills or some sort of permanent portfolio style product, then they can take that risk. Like, so for a lot of things wrong with Elon Musk, one of the things I do appreciate is that he's still going for it, right? Like, I can understand some people, like, it's great. A lot of people make a bunch of money and then they get ultra conservative and they get ultra scared of losing it. And that's why I think even more so, like when we were growing up, people were just living true profligate, right? Like, especially the Wall Street was known as greed is good, all that stuff. It's interesting to me that was it Bill Perkins' book, Die with Zero, is becoming more popular as people in our
Mhm.
industry and people in all the industries are just hoarding money because everybody's so afraid of losing it. You almost have a different problem these days. And then, quite frankly, like you said, what would you do if somebody made 200 million? The whole point is the three of us here talking don't have 200 million. This is why we're on a podcast talking. This is why we have products to sell. We're trying to get there. So somebody with 200 million is not going to listen to you, right? For the most part, unless, like Adam said, they went up 200 million, they lost 200 million. Now they built back up another 100, 200 million. They got the scar tissue. Then now they go, yeah, maybe I should be a little more circumspect about it. But if it's their first go around, it's not really likely.
Yeah, it's a
I
sense.
also think there's an actualization component too, right? Like, you reach a certain wealth threshold and it's not about, can I secure a future for my family? Can I secure wealth security for me? It's, how can I put a dent in the universe, right? It's like, I want to find meaning with my wealth. I want to invest in projects that are going to make the world better, or be exciting in some other way, that is, adding in some positive some way to the world, right? Like, there's something about all weather or cockroach or whatever, which is is retrenching, right? It's a defensive attitude to the world. And I mean, obviously, personally espouse that, you know, people should take a meaningful chunk of their wealth and commit it to that kind of strategy, because you do want to truncate that really awful negative potential downside of, like, bankruptcy with no optionality on getting out of it, or your family's destitute. You've got all these future liabilities for your children, et cetera, right? Like there's a certain amount you want to protect. But once you've reached a point where you can protect that, I I definitely get the idea of wanting to project your will on the world to create positive sum outcomes and to use your wealth for good in that way.
Again, I know you're playing devil's advocate here, right? But you can create a well-diversified portfolio that creates 2x the wealth or half the volatility,
But it's not the
and
wealth
then
is what I'm
use
trying to
the.
say, right? And I don't think we're really, I mean, we're not really arguing. I'm just saying,
Oh, I know.
yes, for if wealth maximization is your only objective, there are ways to do that that are more efficient than most people choose. But for most people with that level of wealth, their objective is not really wealth maximization, it's self-actualization.
Yeah, I think
And
Adam's saying
they're
something
projecting their
incredibly
will on the
prescient.
wealth.
Yeah, he's saying something incredibly prescient. I wouldn't say it's more like defensive. The way I think about it is like we have an I don't know philosophy, right, about the future. And if you don't know, you should really require broad diversification. And at a cocktail party, it's great to know things. It's great to talk about the future and the perversity of the worlds we live in whenever we're at these events or speaking on stage, etc.
Really?
At any of these global macro events, it's everybody's telling me about the future. Tell me what they know. Throw that out there. And then I'm just standing there going, I don't know. I really don't know. I don't have a crystal ball. And like that's not sexy. Like you're saying, it's not like you can call it self-actualization, you can call it make a dent in the universe. It's just not sexy, right? There's just like nobody likes the person that just says, I don't know, right? Our entire society and culture is built on knowing things. And in school, right, you raise your hand and get called on, you're supposed to know things. You can't tell the teacher, I don't know. It's indoctrinated from a young age. And we've had the perspective, I don't know. And that's a very hard thing to live with because it's not cool.
I just think also that what's missing, Rod, we've spent a fair amount of time on this over the last few years, but a lot of people, as you say, they gain wealth through concentrated positions. Maybe, they were one of the early people at NVIDIA or Meta or Google or Microsoft or, any number of 1,000 other companies that have done well and have generated wealth for more than just the founder over the years. They're sitting on a concentrated position that came out of that. And they want to continue to bet on it, or they don't want to maybe face the tax consequences of disposition, or there's a number of reasons why somebody might maintain that. Maybe they're not allowed to sell it for a term, but they're not aware of the fact that they can um, pledge some of the value of that large concentrated position to collateralize an allocation to other positions that may offset some of the volatility or risk of catastrophic loss on that on
Like
that
a
sort of
diversified
concentrated
future
position,
strategy on
right?
top.
So you've got a couple of big positions in Google or NVIDIA or whatever, and you want to hold them because you really believe that this, yeah, in AI and the future of these companies, et cetera. That's great, but it doesn't need to be the only thing you own. You can have that, maintain that bet, and then just, deposit those at, Interactive Brokers or something, and have somebody run a managed futures mandate on top of that. Just use those stocks to collateralize that strategy or any other kind of strategy, like a tail hedging strategy or what have you. For example, maybe your AI bets are going to pay off, but the US economy is going to go through a major recession or liquidity crunch, and your bet on AI is right, but the US, but the global economy implodes, and so like there's just things that you can do to diversify while maintaining most of the actualization
Sure.
of that concentrated bet that you really want to make.
Sorry to interrupt, but I did want to take a quick second to remind listeners that while we do absolutely love providing our audience with world class guests and weekly investment insights, we wanted to remind you that we actually do our best work outside of this podcast. And we try to do this by providing cutting edge, globally diversified, and systematic investment strategies that are designed to be broadly non correlated to traditional equity and bond portfolios. So we actually manage private and public funds, as well as bespoke, separately managed accounts for investors that seek the potential to smooth out portfolio returns in the long run. So if you do want to see that theory that we've been talking about put into practice, please do go ahead and check us out at investorresolve.com. Now back to the podcast.
Yeah, I want to touch on two things that you said there, Adam, but I'll also get to like is going back to Rodrigo's previous question is like, a lot of times we deal with a lot of people coming out of like the e-commerce space and everything, and they go, I know things or whatever, and like people have Gell-Mann amnesia, and they go, I sold products on
Yeah.
Amazon FBA, I understand Amazon. I go, really? Tell me who the CFO is, right? They have no idea, right? Like, so they're doubling down on their risk or their exposure to Amazon by buying Amazon stock. And I personally believe, and this has been the hardest thing to maybe get any sort of following with or get any sort of foothold, is that entrepreneurs, business owners should actually not hold any offensive assets. They should only hold defensive assets. Because if you're buying, stocks, bonds, private equity, private credit, VC, real estate, you're just doubling down on your long GDP exposure. You're doubling down on hopefully volatility doesn't hit the markets. You're just doubling down that credit and liquidity is a wash in the future. And so you're really just really double or triple or quadrupling your exposure to that sort of environment, and that's where you get hurt the most. So we always think about what we do as like an entrepreneurial, hedge, but that's really hard for people to gain traction on. But going back to it, then Adam's point that I think the two interesting things for us to talk about in that vein that I'm curious about how you guys work around is one, our mutual buddy Corey Hofstein was on my friend Bill Brewster's podcast the other day, and he was talking about the capital efficiency, which Adam was just kind of referring to. But what I think that's missing, a lot of times people hear that through return stacking you're adding leverage, but what they don't realize is there's not that deterministic payment schedule that you get in leverage in anything else, right? Like if I buy a house or commercial property, every month, let's call it the 15th, that debt service payment's due every month on the 15th, right? And if I don't have the cash flow that times perfectly with that 15th, I might miss a payment and now I'm in default. If you're trading futures and options and you're getting that financing cost, which is like roughly about the 3-month T-bill rate, it's baked into the term structure. And you can go long or short depending on that term structure. And I don't think it's talked about enough that that is a huge difference in using capital efficiency or leverage if you don't have a deterministic payment schedule on like the 15th of the month. That's where you can truly get into trouble with leverage. And I'm just wondering if you guys have thought about different ways of talking about that, and then we get into the second one as well.
I think I have some thoughts about different aspects of the leverage side of things, but in terms of the non-deterministic, the fact that, the pricing can go up and down, I don't know, Adam, if you have any thoughts on it.
No, I mean, my big question is always, you know, because for most people, their experience with that is real estate, right? And the challenge is that that bet on real estate has, for the most part, paid off. I mean, I think it would be really useful for you to share. I know you've done this on occasion, but share your experience because I just think like the hardest conversations to have are with people who've gotten very wealthy with real estate portfolios, right? They literally are like impossible to shake free of their belief that real estate is the way, right? And like leveraged real estate especially is really the way, right? And like for the most part, Rodrigo and I don't even bother. Oh, you got wealthy in real estate? Gotcha. Yeah, I don't
So,
really
yeah.
have anything to say to you at all. The entrepreneur has a similar bias, right? For reasons that we've sort of touched on, but you know, the entrepreneur wants to invest in other entrepreneurs, right? Like if they've gotten wealthy, I don't want to diversify. I want to bet on other entrepreneurs. I understand what it's like to be an entrepreneur. I believe that, I understand entrepreneurship. I can identify other people who are likely to be successful entrepreneurs. Why would I do this, diversify into this thing when I've got this gift, right? So those two types of individuals, I feel like they're never going to get what we're trying to say, and nothing we can say to them will overcome their lived experience.
Yeah, as Rodrigo used to always ask me, like, "You're in the Bay Area, why don't you go down and talk to those VCs about, like, tail risk hedging, long volatility, and commodity trend? Because it's the perfect complement for VC." And I'm like, "Have you ever talked to VC? They're not interested at all, right? It's just YOLO it, and then, keep YOLOing until you
So
can't anymore,
confident.
and then you raise another fund." But that's fine, like, to your point about Adam, about commercial real estate, that's, what I have a background in. And at best, commercial real estate's unbelievable tax alpha in America, let's, X the rest of the world. unbelievable tax alpha that I don't think people truly understand or fully take advantage of. And that's more important than anything else, is the tax alpha of being a real estate professional. And then in the best case scenario, you build a 1031 golden cage around yourself. So you're constantly rolling properties and refinancing properties to never have a tax consequence. And then next thing you know, you've built up this, $100 million cage around yourself where, yeah, you could tap the liquidity through refinancing and everything, but now you still have those deterministic payments like we were talking about. And can you service those over time, especially if something bad happens? And people don't realize how much of real estate is just floating rate debt, right? Like you can't really get more than 5 to 10 year terms, and it's usually floating rate debt. So it makes it incredibly difficult, especially to service the cap rates where they are. And then Adam, you asked me to talk about. So actually, somebody just asked me at this event in Austin. It was interesting. They asked me if I was over levered in real estate, and I was like, in 2000. So I was a commercial real estate developer in Charleston, South Carolina, going into 2007, 2008, the great financial crisis, and end up blowing up, for lack of a better term. But then the question about was I overlevered? I said yes and no. In a way, obviously real estate requires leverage, right? Like you don't put 30% down in cash, the bank finances the rest. But it's not necessarily the leverage that kills you. It's the time horizons and the granularity of those investments. So if I'm building out real estate developments that take 2, 3, 4, 5 years to come to fruition, I need the environment to stay low volatility. If low volatility or rates pick up over that time horizon and people can't close on, let's say I'm flipping condo units or whatever, then I get crushed and I can't make my payments. So it's not necessarily the leverage that's the issue in real estate. It's those deterministic payment schedules and giving the global macro environment and a liquidity crunch. Can you roll over that debt? Can you refinance that debt? Or can you make your payments on time? So that gets back to what I was saying about what's beautiful about managed futures or options is you don't have to
Right.
necessarily worry about that payment schedule. It's baked into the term structure of the instruments that you're trading.
Yeah,
Yeah,
you're
and it's a
trading.
negative carry unless you're earning
Right.
expected positive carry in other dimensions from the trade, right?
Yeah, it's I mean, for those who don't understand it, a futures contract, you're getting the price movement of the excess returns above cash, right? So it's what you're trading is already stripped out from the cost of borrow. So if I were to put up treasury, the price return of the 10-year treasury index fully paid up, like an actual bond return, and I were to put up a treasury futures contract, like a roll, kind of stitched together roll yield just to compare, what you'd find is a big gap between one and the other. I think oftentimes when I say, listen, I'm buying a 10-year treasury futures contract. Okay, great. So we're going to get 10-year treasury returns. No, no, no. You're going to get 10-year treasury returns minus the cost to borrow, right? And what you trade is the excess returns. And as a long short futures manager, you have the benefit of being able to trade that line long or short. If it's, if there seems to be some sort of expectation of continued cost to borrow and treasuries are going down more aggressively, then you can play that by going short that thing, right? So when we talk about overlays and we talk about the benefits of future strategies, the reason that when we talk between us, between one CTA shop and another, we always talk excess returns. We don't talk about total return. So what does that mean? If you've had 4% annualized excess returns, that's what you're stacking. That's already taken into account the borrow. So when people ask me like, "Are you sure you're going to be able to outperform the cost of borrow long term?" I'm like, "Well, every CTA manager that that survived has had to overcome that cost of borrow. It does a good job at doing that. So you're really just stacking that little juice on top, regardless of what the borrow is. And you've seen the benefits of that in periods where rates were really, really high. You've seen CTAs provide positive outcomes above the rate of cash, and you've seen them do it when rates of borrow were low, right? So that's a nuanced part of the discussion that few people really truly understand at this point.
And even
And go ahead.
I was gonna say even better what you guys are hinting at is that borrow rate is like close to a bank lending rate, right? It's like that roughly the 3-month T-bill tracks over time. So more importantly, I think Corey's kind of alluded on this podcast, on the previous podcast. I don't think he can necessarily say it. I mean, might want to time step. I'll say this, and you guys can tell me if it's regulatorily viable. But what I think is fascinating that I always think about, if you want to replicate, and I want to get more into tax consequences of like a real estate really is a tax alpha, as I explained. So you have to fully understand the tax alpha you're getting in real estate. But what's interesting with your guys' products, like if you're return stacking stocks and bonds, and let's say I want to build a 50-50 portfolio of stocks and bonds, right? I can get much more capital efficiency out of your guys' products. And I can allocate, let's say I'm sitting, we'll make the math simple, even though good luck finding houses for these prices. But let's just say I have $1 million, right? And I want $1 million portfolio. of stocks and bonds. Well, I could put up $500,000 into products similar to what you guys run, and then I'm sitting on 500,000 in cash. And for that leverage to get my notional value of that $1 million of 50/50 stocks and bonds, like we said, I'm borrowing now at the 3-month T-bill rate. Now, people are used to going to their brokerage like Schwab and borrowing. And right now, that's what, 10, 12%? It's pretty insane.
Yeah.
The best one is Interactive Brokers or pass through SOFR at size, but you're getting closer there. So I can borrow then at the T-bill rate, and then I can use that $500,000 cash left over. I can go buy my house cash if I can find a house for $500,000. Let's just make that assumption. And then more importantly, I can then pay myself back like a loan. I can now be my own bank and provide my own mortgage, pay myself back plus interest. None of these are taxable consequences. And it's a way to use that capital efficiency to be my own bank and not be giving that VIG to the bank where over time I may be paying double or triple the actual value of my house by financing that mortgage through a bank.
Yeah. That's like that use case it's just about borrow. How can you find the cheapest borrow on the planet? Okay, so if you want to find the cheapest borrow on the planet, you go where the vast majority of the world, the capitalist world goes to in order to achieve that without having to physically go out to 5, 7 banks, say, hey, I need $100 million loan. Who I want you all to bid on it and give me the cheapest price. Okay, which is I got to do paperwork with that bank and then that's not how it's done at that level. At that level, what you do is you say, I'm going to go to a futures contract. I need to borrow treasuries, 5-year treasuries, 10-year treasuries. I'm going to go to the futures market because if there's a futures contract that is charging me more than the cheapest bank will charge me, there's an arbitrage there. There is somebody that's going to be willing to take out that loan and then place the shorting position on the futures contract, and then that futures contract goes in line with market, the margin of the market. So when we think about derivatives contracts, the reason they're so valuable is that you are getting the same rate of borrow as an institution would. Let me say that again. You now with products out there in the US and Canada that have these derivatives inside, these stacking inside, you can now get the same borrow as an institution gets. I mean, that alone is mind-blowing, right? And yes, there are portfolio construction use cases for that, but like you said, Jason, there's also a very interesting use case of, hey, I have $1 million portfolio. I want to stay in the market and I want a mortgage or I want a house. How do I get exposure to real estate in a city that I like and also get exposure to markets and do it cheaply? Well, the cheapest way to do it is if you can get yourself a futures contract type of borrow, right?
And
And
then it
that
takes along at that notional value, which is the most important thing. So you're not selling off your portfolio to buy those assets. You're still maintaining that notional level. Let's say the example I used that $1 million. Similarly, the way I think about it, what we do as an entrepreneurial hedge, if I want to maintain my notional at let's say $1 million, but I have a creative entrepreneurial idea. But as we all know, business is very risky and it's most likely to fail. But if I carve off 10% of that, what we call portable alpha or capital efficiency, and I put $100,000 in this business, but I'm maintaining my portfolio value of that $1 million. Let's say I blow through all that $100,000 on that business I thought would succeed. Well, it's not going to hopefully take me too long to make up for that because I'm trudging along at that notional value of that $1 million. And that's why I think about what we do much more as like an entrepreneurial hedge because I know how difficult entrepreneurism is, or like buying properties, et cetera. Like all these things are inherently difficult, and you inherently can't see the black swans in the future, or you can't see where your risk lies. So how do I reduce that risk? How do I hedge away a lot of that risk? And I think there's much more interesting things with the products we all create to hedge a lot of entrepreneurial risk. And then maybe especially if you're raising capital from friends, family, outside sources, having a much better fiduciary responsibility. You may need to raise more capital to maybe hedge that risk. Like we used to, it's very similar to, they're starting to come back, thankfully, like zero coupon bonds, right? Principal
Mhm.
protected strategies, where at least you got returned that principal, and you could use the delta between what you needed to post for that 10-year, zero coupon bond now, and use that for more risky investments. So it's about those things. Like I think it's a little bit better maybe than principal protection because like you can hopefully make a return over time given that 10-year time horizon that you may outpace that zero coupon bond and maybe not miss out on the inflationary prints. But I think it's a very interesting way of looking at either housing or entrepreneurship to use the ideas from return stacking or capital efficiency that we're talking about. But the other thing that we've been hinting at is taxes. And I'm curious the way you guys think about it for, let's say, for US based investor that's a taxable investor, they're not put in like a self directed IRA or any 401k, anything like that. Is how do you think about with like a return stack product, especially when you're adding those managed futures in there? Because I think generally, like, everybody loves the mantra of low fee, no taxes, right, in ETFs. But we all know as soon as you put commodities in there, you have the 1256 contracts. They have a preferential tax treatment, but they're going to be taxed, right?
Yeah.
And so that's another hurdle for you guys explaining the complexity of what you do. So how do you think about, do you think you have to produce, excess returns over a 60/40 benchmark with the managed futures to be able to compensate them for the tax consequences? Or how do you think about the delta of the tax consequences when you're talking to investors?
So I think this is an this is should be a relatively simple one, but of course, when we think about traditional portfolios, you're thinking about I have X, I have $100. That $100 made 110. A portion of that is owed to the tax man, and so that they're going to take away that return, right? So let's say I'm investing in the S&P 500, I make 10%. You got to pay, and you sell it, so you have what a year should be long term capital gains. So you have to pay the tax on the long term capital gain. The concept of futures on top of an S&P 500 or the futures on top of anything, if you're stacking whatever it is, and you're using futures to do it, is the S&P 500, let's say, makes you 10%, but you've used margin on that S&P in order to have another type of return in the future space. Managed futures are taxed as 60/40, meaning 60% of it goes to long-term capital gains, 40% goes to short-term capital gains. To be honest, I want to take that back. Forget about how it's taxed, right? Forget about how it's taxed. Let's say it's taxed at 80%. Okay. The fact that you stacked it on top of the S&P 500 is that you are going to get something above that 10% if that strategy had a positive rate of return, right? So you get your 10% from S&P, you're going to get taxed on that. You may or may not get taxed on that if you don't sell it. If you do sell, you're going to get taxed on it. And then whatever that future strategy made you is going to be above and beyond that. And if they take away 80% of that, it's still a positive outcome for you, right? So as long as you find a stack that's stacking positively, taxes are less of an, you're still better off doing it than just investing in the S&P 500, is what I'm getting at, right? Now, if people do care about maximizing the returns on that and understanding what that means, if you're doing a full separately managed account, like Adam was alluding to, something like, somebody owns an NVIDIA and then you stack the strategies on top. Well, the NVIDIA is not going to be sold. You will be paying taxes on whatever future strategies you have, and that'll be 60% long term, 40% short term. And then if you're doing it within a public structure, so all the managed futures funds, any returns that come out of financial assets like currencies, equities, and bonds will be 60/40. But then the big, curveball is how much of your returns this year came from commodities, which is traded on a Cayman blocker. That's going to be regular or ordinary income. And so it's a little bit complicated to say to somebody, here's what you can expect every year from a 40 Act fund, because it'll all depend on where the returns came from. And if we have a year like the last couple of years where most of your assets are in T-bills and you're getting 5% on that, then you're also paying tax on the T-bill. So, I think it becomes cleaner. If you're a separately managed account, it's much more clean. If you're a 40 Act fund, you have to just kind of keep track and keep on communicating with investors about how it's going to look like every year.
Well, the good thing for you, though, is it goes on to 1099 income, or we're K1s, and people hate K1s. So I'd much
Right.
prefer the 1099 tax breakdown. So I want to bring Adam back in before he falls asleep. But also, like, by the way, is this
Uh,
my interview or you
Buck
guys'?
is Buck hosting this and making
Yeah,
sure
if
that
I'm
all the
hosting.
guests are
No, because
being attended to.
I had a question that I should have asked you privately, but like, it makes me think about, so CTA trend following strategies, right? If you're running a replicator strategy, either top down or bottom up, and let's say you're using your benchmark SocGen Trend Index, right? As we all know, SocGen Trend has just the 10 biggest trend followers in the world in it, in equal weight, right? And as we all know that in the last few decades, those big managers focus more on the financials than on the commodity space to be able to raise more AUM, right? And as we know, 2010s was a tough time for trend following and that sort of thing. I mean, still, I think it did great, like, especially if you can return stack it, at that like 2% CAGR. I think that was SocGen trend in 2010s. Like, great, whatever. And we'll get back into that in a second. But like, the idea, though, I wonder, though, by running a replicator, it's not necessarily top down or bottom up replicator. My question is more like, if you limit the scope or the choice of the instruments because you're trying to stuff it into this ETF wrapper, like, how much does that concern you? But it does great for replicating that SocGen trend because those big managers focused on the financials. So you can kind of reduce to the financials. Very similar. I mean, Andrew Beer's not here to defend himself, so I won't talk about that necessarily. And I have zero problem with any of this stuff. I hope people load into commodity, ETF managed futures. But like you miss out, and we'll get to the last few months, you can get some crazy trends and like these obscure soft contracts, right? That you're missing out on by reducing the universe that you allocate to try to replicate a SocGen trend index. I'm not sure if that makes sense, but do you see what kind of where I'm going with there?
Well, there's a couple of different points I think you're making, right? But one of the big ones is that the replication indices typically have a narrower universe of markets. And for scale reasons, they tend to skew more financial. Now, the way that um, the replication takes place, there's no necessary bias, right? If the index itself is not skewing to financials, there's no reason to think that the replication strategy is going to be biased to financials. You make a point about larger managers needing to focus more on financials because of liquidity and CFTC limits in commodities, and that's an absolutely valid point. And I think that's the big point, which is that if you're in the top 10 CTAs by market cap or by AUM, then the amount of excess juice you're able to extract from more peripheral CFTC limited or low liquidity markets is relatively small anyway. So, like, while a small CTA manager may be able to put up gargantuan returns because a very illiquid market has a real spiky, like, remember orange juice a few months back had a huge run.
Cocoa now, I
Cocoa
think.
is now.
Yeah.
Yeah, we have
Cocoa is
cocoa,
certainly more liquid.
cotton. Yeah.
Cotton is now, yeah. But um, OJ is great because it's very thin, right?
Yeah.
You can't be a large CTA and trade OJ in any size. So if you're a small CTA, you can trade OJ in like the same size you trade ES. Well, if OJ is going to run as an illiquid market, it's going to show up as really strong percent returns in those months that you're capturing those OJ returns, but it didn't really translate to much in terms of actual dollars that are accrued to the fund or to the strategy, right? And you're a big CTA, you might trade 400 markets, but you know, 80% of your returns in terms of the dollar returns are going to come from the same kind of 40 markets. And most of those are going to be financials. So you need to take steps, either heuristic steps as you're forming the portfolio to say, you know, even though majority of my markets that are liquid, that have high capacity are financials, I'm going to limit my allocation to those financials to ensure that I'm getting the same amount of risk or my target amount of risk from commodities, right? That is an active decision that may limit the amount of scale that the strategy will have, right? So it's just trade-offs all the way down. And, you know, you can't scale a multi-billion dollar trend replication strategy and also trade 80 markets in full size. Like it's impossible to do. And the fact is, because most advisors are more concerned with, did I under or outperform this benchmark of big managers than they are with, have I maximized the potential of trend strategies, then this kind of replication works really well. If you actually want to maximize the performance of your CTA allocation, there are other ways to do that, right? We run other strategies that more formally have that objective. But that's not the objective that people are going for when they buy a relatively low fee stacking product that is primarily designed to replicate a benchmark.
Yeah, I think another example is this: when lumber took off during the pandy wandy, right? The reason it
Yep.
took off was because the float was so low. It spiked
Mhm.
because nobody's trading it because like you couldn't really get in there. So a little bit of money could move those real markets tremendously, and that's why I was lock limit up every day. But like you're saying, I think it's interesting on the soft side, the year to date, like those cottons and cocos are ripping. You could also been short your grains, but like what size can you get off and how much percentage of your returns are coming that. But I think also, like you said, I think it's perfect to say there's trade-offs all the way down. I think that's really inherently what our business is. It's every day just dealing with trade-offs and trying to figure out which trade-offs you can accept and which ones you can't. especially when you're trying to productize something for retail clients. I think what I was getting at, that I think you're alluding to, that I think is interesting that you'd maybe have a broader answer to, is going back to where we started of like, people is always, what have you done for me lately? Right. During the 2000s, 60/40 was like underwater. Right. So you had the rise of like managed futures, alternatives, everything during the
Active
2000s. So
last
everybody,
allocation.
right, but
Yeah.
it's like these slow-moving cargo ships, but it takes like 10 years for people to get there. They see the back 10 years, "Oh my god, the alternatives are amazing." Then they rush into all these strategies, right? And then the 2010s, the alternatives do poorly after the money's flowed in, and during the 2010s, 60/40 comes roaring back. So now we're here in the 2020s, everybody's talking about 60/40. Nobody wants alternatives. Is that part of it? And then what I'm getting at is I haven't really double checked, and I'm curious off the top of your head without, putting you on the spot, is like during the 2010s and coming into now, like I said, those SocGen trend managers were primarily financials. Um, when you really need those CTA most, do you really need those less liquid, obscure markets like in
Yeah.
the
This is what I
1970s
was
when they produced their returns, right? Like, so maybe we're looking in the hindsight bias of the last 20 years, saying you're fine, we're replicating with the financials, but maybe when you need CTAs most for like if there is a commodity super cycle, then you need those smaller contracts that are less liquid.
The only
well,
way,
look,
way to really get material access to commodities is by investing in a large number of small managers, right? Because any single manager has a finite um, amount that they can allocate to any particular contract under CFTC limits, right? So if you want a really broad exposure to more esoteric markets, you just cannot get that by buying AQR or buying Winton or AHL, right? They've got phenomenal research teams. They run great strategies, but they just cannot possibly allocate materially to the tail of esoteric contracts. The AHL alpha strategy has one of the best track records in the business, but it's a, you know, secondary and tertiary market strategy. It doesn't even trade any of the more common liquid futures markets. And by design, it therefore cannot scale to hundreds and hundreds of millions of dollars, right? The trade-offs are along a few different dimensions. One of them is access, right? Like you can run a much more complex, diverse managed future strategy within a mutual fund. And you can very easily return stack in a mutual fund the same way as you can in an ETF. But getting shelf space as the mutual fund from, all of the major wirehouses or RIA platforms or whatever is a lot more complicated. And, the zeitgeist right now is there's no dignity in buying mutual funds. Everyone wants to buy ETFs, right? So, you launch something ETF. There's things you can easily do in a mutual fund you can't quite as easily do in an ETF. There's trade-offs. A lot more investors from around the world can buy an ETF than can buy a US mutual fund. But you're slightly more limited in what you can do in an ETF than what you can do in a mutual fund. So, access is a really big um, dimension. So, just figure out who you're trying to serve, what the objectives are, what the objectives of the end buyer of the product are, and then try to optimize. And different clients are going to find, you know, optimal exposures through different means. Clients with really big positions in Google and Meta and, whatever are going to want to have those on a deposit at Goldman Sachs or Morgan Stanley or Interactive Brokers and run a future strategy on top of that, right? That is vastly more efficient. You can get as much access to esoteric markets as you want within the limitations of whatever are offered on that, you know, brokerage platform. But if you're not in that position and you're a retail investor or you serve retail investors, you've got a more limited product list and, you make do with what you can.
Maybe it's just me, like, in my via negativa in general is like, I think it's important for us to illuminate or elucidate those trade-offs. Like, because I think that's like, a lot of times, I'm sure before you guys launched your products, we were getting those questions all the time. It's like, why can't you bring that institutional quality portfolio and stuff it into an ETF tax-free and low fee? And I'm just like, here's all the reasons why we can't. I wish I could, but I can't do it. And, write your congressman or whatever it is. Like, there's
Right.
all these rules in our industry that make all these trade-offs that we have to think about constantly extremely difficult. And it was also made
Yep.
me think about Rodrigo, you're, saying questions about, selling rationally and explaining, and using historical representations. I think it was Jason Zweig said something like, I can draw you a picture of the snake, but if I throw a snake in your lap, you're going to react differently. Like we've always heard it a million times. Like people are like, oh, if the market's down 30 to 50%, I'm a buyer. And I'm like, really? Have you lived through that before? Do you know like how you feel like the world's ending, everything's going to shit and like all that stuff? Like I think it was I think Phil Brick, I think retweeted it, but my partner Taylor wrote an essay about like stocks for the long run. And it was interesting, even just trying to look at basic things. If you look at global stocks from the 1840s to now, it was like in over 30-year time horizons. And if you look at the 25th percentile, it went from a 7% CAGR down to a 2% CAGR, right?
Yeah.
So then over a 30-year time horizon, I mean, you have a 1 in 4 chance over a 30-year time horizon to make a 2% CAGR on global stocks. And that was the difference between starting with 500,000 and retiring with like 910,000 versus starting with 500,000 and retiring with 3.8 million if you could get that 7% CAGR. And this is the idea we're talking about with non-ergodicity, right? Those issues. And even worse, over that 30-year time horizon, you had a 1 in 8 chance of finishing underwater over a 30-year time horizon. 1 in 8. And if you go to 20-year time horizons, it was 1 in 6 of finishing underwater. But like I said, we can show all those things, but I don't know how you get people to believe those things. Like it's a very emotional versus rational perspective,
Well, it's
but we try to
statistical
find the
time
people to
versus
bend to them.
behavioral time. That's
Right.
Asmus's recent statement, and I think that's 100% true. Right? How do you get people to deal with and get as close as possible to statistical time with their behavior? Honestly, I think a good advisor that understands what we're talking about, that's kind of if I'm going to pay anybody for anything, it's got to be for emotional handholding. The problem is, as it stands today, I'm Des, by the way, if there are advisors out there who are doing all terrain or stuff like that, and they really know it and they know their stuff, reach out to me because there's a ton of retail that comes to me and asks for help, and I only have a handful of people that they can talk to, like very, very small elite group of advisors that are willing to do that for smaller clients, right? But and then after that, you have to handhold, and that's what you're paid for as an advisor to make sure that they stick to it. That's how you get closer to statistical time with your behavior, I think.
Yeah. I
I
think
do
the
think you need to grant investors a little bit of the benefit of the doubt. And I will say that it's taken me a long time to internalize this, right? But it is legitimate to be attempting to find a Pareto frontier between minimizing the risk that all your peers, your peer group are going to outrun you. Um, and that, by doing something different, you may end up in the um, I failed and I'm alone instead of the I failed, but I'm with all my friends who failed with me um, quadrant. Like it, it is a difficult thing. You can know what's right from a wealth maximization or utility maximization standpoint, and then still also recognize that we live in a social world with a community of friends around us that we like to spend time with. And, everybody's sort of concerned with maybe not day to day preserving their exact social status, but, you know, being one of the gang, being one of the group. And ta-
I mean,
stepping too far out of that is
it's
very
so funny.
uncomfortable and probably
Like,
not rational for most people.
I was at a dinner party on Saturday, and everybody was in a good mood, right? We had a guy in real estate. We had a guy who was a stock trader, long only. We had an investor that had like a portfolio that was 80/20. We had a business owner that whose business was booming. Like you said, all of the things tied to positive GDP. I'm gonna steal that one as well, Jason. And everybody was just in such a good mood. Everybody was talking about how well they were doing their Bitcoin portfolio. Yeah, I forgot about the Bitcoin guy, right? Like big portfolio going through the wind. I'm like, you know what? My portfolio is up like 4 or 5%. My all terrain portfolio is up mildly okay. I'm not complaining, but I'm not as happy as the rest of you. Everybody's ecstatic and there's something wonderful. But I'm like, good for you guys. Like, it's great. Everybody's in a good mood. Everybody's doing great. I love these moments because the wives are happy, the husbands are the kids are happy, you're taking extra trips. There's something to that social, like being part of that. And if you exclude yourself from that, it might be a little shitty. But I kind of want to tell me your thoughts, Jason. But I do want
Yeah.
to get into volatility a little bit before we end
Yeah,
the
of course.
podcast. So tell me your thoughts, and then I have a question for you.
Yeah, I think what you're saying is like we're not perma bears at all, right? Like you said, these high liquidity, long GDP, stock market up environments are great. Like we all have friends and family. It's awesome, right? Like, and we want to participate in those. And that's the beauty of capital efficiency or return stacking is like you can give them those stocks and bonds, and then you could stack in those defensive strategies that hopefully jump out behind the curtain and they need them
Yeah.
most, right? So you're giving them exactly, hopefully, what they're looking for. And what Adam was saying is about finding the clients. Like I couldn't agree more. Like I believe in the clients. Like you're sending out your bat signal, Adam, when you say like Pareto, utility maximizing, and when you're doing these dance on here, it's because like it's maybe 1 out of 1,000 people that agree with us. And so that's all you're trying. That's what I'm saying. I'm trying to find is like the 1 out of 1,000, focus on them, eliminate the other 999. They don't like the cut of our jibs. And so it's just trying to find those people that agree with you. And I think that I don't know if we've talked behind the scenes before, but I think what is interesting when you're dealing with financial advisors is you might have a financial advisor that buys in, but now they need 50 of their clients to buy in. And I think that's much
Hmm.
more difficult than people realize. And I like to kind of control that narrative with my clients because I know exactly who the end client is. And because if the advisor fully buys in, the clients don't necessarily, they see those negative line items, they start complaining. Then they're gonna make the calls to the advisor, and the advisor's eventually gonna cut you just even though they don't want to, but then you're getting that whole cloth. You're just getting cut off because they believed in you, but the clients didn't. So you have that secondary effect.
Yeah.
So I just think that's interesting. But what do you want to talk about, Evolve?
Yeah. So I just want to, I think ball has been very confusing for a lot of people over the last couple of years.
Yeah.
And
Yes.
so you now have,
Was before when it wasn't confusing at all.
Exactly. Exactly.
well, I think there were certain expectations of volatility that in a lot of people's minds didn't come to fruition. And you're currently one of the funds that you have for those that have big positions is that defensive fund. And I know part of that is commodity CTA, but part of that is volatility. Now, how do you describe that volatility element, especially in the face of maybe we can talk a little bit about how those long volatility managers performed in 2022 versus expectations, and then how do you articulate what to expect from them?
Yeah. So I'll start at a high level. And one of the things I was yelling from the rooftops and even talking to you guys prior to 2020 about is when I look at the defensive side of the portfolio, commodity trend advisors do incredibly well, right? They have a high beta to high inflationary environments. They have a high beta to recession, at least protracted, prolonged recessions. They've allegedly done well, and that's how they originally got that term crisis alpha that they've kind of walked back from. The only time they have problems is when you have acute liquidity cascades, right? Like March 2020. And I was really scared of that prior to March 2020, and exactly what happened, right? They're on the long side of the trend. They're on the same trend as stocks and bonds. Everything, correlations go to one, even your CTAs go down together in an acute scenario like that. That's why I believe in tail risk protection. So the combination of those two are very powerful. Like if you have a sharp liquidity event when everybody's caught on the wrong side, you need some long volatility or tail risk protection. If you have a more protracted recession like a 2008, 2022, your CTAs are likely to do better. And that's why I think the combo is very powerful for the defensive side of the portfolio. In 2022 was interesting. Like you said, has anybody really understood vol? Like, why did I pick one of the hardest industries to try to explain to people is always difficult. But the thing is with volatility, there's so many different path dependencies. There's so many different ways of trading vol. Even though we are philosophically aligned, the thing that we do that I think is a bit different is we try to build institutional style portfolios. And what I mean by that is maybe a lot of retail clients don't understand is that, your large pensions, endowments, or multi-strat fund of funds, they look for individual hedge funds that do very, very niche strategies. And it may not be like an absolute return strategy, it may not be anything. It may be a very specific strategy. And what they do is they aggregate those together into ensembles, and that's how they build their portfolio, which is very different from the way a retail client may assemble a portfolio. So that's what we try to do. So when we think about like the volatility space, like I said, there's a lot of different path dependencies. And so we have 14 managers in that vol space, and we kind of look at them across relative value volatility, long vega or long volatility opportunistic trades, tail risk trades, and even short futures, like intraday trend following on short futures. Like those are the kind of spaces we look across. And even inside of those buckets, we use once again that fractal ensemble as well, where we have different managers attacking it from different viewpoints. Now, the reason we do that, like I said, is the path dependency. So in 2022 specifically, like you're asking, Rodrigo, the interesting, just like CTAs have a large dispersion of returns depending on what they're doing, volatility has a large dispersion of returns. So in 2022, the delta between our top and our bottom manager was about 60%. We have
Holy
one
crap.
manager up about 35 and another manager down 25. So that gives you an idea of the dispersion
Now,
of
were these
returns and why
long ball managers or just ball managers? Because
these, this specific one is long ball managers, and I'll explain a little bit why. So as long as you have a kind of mid-range vol environment or a decent, pops are here, there, and vol, relative value volatility is kind of those pairs trading, going long and short. They can kind of make money in any vol environment, except for when we're in like a 2017, 2019. where vol's just dead. Very hard for anybody to make money in the vol space. So that's relative value. On the other sides of the vault, like I'll call them opportunistic long vol trades, you might have managers that are looking to basically trend follow volatility, right? As implied volatility or Vega expands, they're waiting for it to start expanding. When it reaches a breakout, they're jumping in and riding that up before it mean reverts. So managers that were doing that style in 2022 had a lot of false breakouts, right? So they were just like a CTA, a lot of small losses that start those death by 1,000 paper cuts start to really add up into real serious losses. So that's where the problem was in 2022. In 2022, though, you had this like medium to high vol kind of environment was still that echo of volatility from 2020. So managers that were trading more long gamma is a way of looking at like long realized volatility. So that's the difference between kind of gamma and vega as implied versus realized. And I'll give a really simplistic example. If I'm long and at the money call, right, I'm long gamma and long vega, right? And the gamma is the acceleration of my delta or my exposure, and my vega is the long implied volatility. But then I calendar that, right? And 6 months out, I go short and at the money call, right? Which would be a short gamma, short vega trade. But because gamma's highest at the money and you're offsetting against theta, your time decay, if you position that right, you're going to have a long gamma trade, short vega trade. So in a market like 2022, where you're having these like little movements in volatility and you constantly restriking and you have that long gamma or gamma scalping position and you're capturing those realized vol, where realized vol a lot of times was popping higher than implied vol in 22, those managers did incredibly well, right? The other managers that did really well in 22
And
were the
just
ones that had,
can I stop you
yeah,
there?
please,
Well,
yeah,
those
please.
managers have done just as well in a continuation of volatility spike?
I'm gonna get to that. You really need like that continuation is debatable how well they would have done because if it starts to affect an implied volatility, right now you're short Vega, you're short the implied volatility, you got a problem. And I'll get to kind of that in a little bit. The other one that did really well in 22, particularly this trading style, is cross asset volatility. So if you were buying, deep, money or like let's call it 7 to 10 year leaps, if you had an ISDA on cross asset volatility, and also on rates vol, FX vol start spiking, but S&P vol is down, then you can make money on the cross asset volatility. Now the problem is if you have a portfolio like ours, and most of our clients are tied to S&P 500 vol, you can only kind of sprinkle that in around the frontier. Like you don't
I
want to
wanna
take
understand what you mean by cross-asset volatility. Is it the volatility of, like, how many assets are we talking about?
like all that, like think of managed futures, like that whole entire space. Like
Got
if
it.
if you have an ISDA, you can buy a 7 to 10 year leap on almost everything and have like a swap that is a mark to market daily. And so the idea is, if you're in rates vol, you're in FX vol, you're in commodity vol, you would have done well in 22, right? But then to the flip side of your question, the continuation or discontinuation, those managers that did the best in 22 probably did the worst in 23. So this is
Right.
why you have that ensemble of returns and that dispersion. And the ones that were maybe doing the trend following on vol, they didn't even have any opportunities in 23. Because I don't know if you guys remember, 23 is very similar to 17 or 19. We had 2 days in the entire year where the market moved plus or minus 2%. We had 2 days of backwardation. Like it was only, I think it was in maybe like 2 days where vol went above 20. Like it was like the lowest vol environment in 23, similar to 17 and 19. So
Okay.
that makes it difficult for any vol strategy. So you aggregate those up, that makes it difficult. But like you're saying, if you're doing that cross asset vol, and then let's say you have a liquidity event like March of 2020, everything crashes except for S&P vol spikes because it's the most liquid market in the world. You may be getting a trade-off, right? You're taking basis risk, as we know. Like by not pinpointing your risk, you're taking that basis risk. So you have to be, once again, trade-offs all the way down, as Adam referred to. So those are the kind of things that we look at is like trying to have a sprinkling and a diversification across all strategies. But like that kind of dispersion across the vol space is similar to the commodity trend space is why I firmly believe on broad exposure to
Especially
multiple
small
asset classes.
managers in the CTA space that can trade those
Yep.
smaller markets in size. So when, but ultimately, when you look at the ensemble of volatility, all of those managers are trying to make money in periods of abrupt illiquidity and abrupt losses, right? They're all trying. It's not gonna mean that they're all gonna. I'm actually asking, are they all trying to do that? Like, are they all expected to make money in 2020
Yeah,
in
so
their
for the most
minds?
part, it depends on
Or
who you pick. Like a relative value, like so we try to find relative value managers, which I would argue that pairs trade is implicit short volatility. Whenever you have a sort of pairs trade on, and by a pairs trade, I mean like between S&P and VIX or a calendar spread or whatever. They're trying to just pick off like a little bit of that pairs return, but we try to find managers that still maybe buy the wings. So in a March 2020 sell off, they make money, right? But yes, then the rest of our portfolio, the opportunistic long vol trades, tail risk trades, et cetera, they are really trying to make money in a March 2020 scenario. But like if that doesn't materialize and people are fighting the last battle, it can be difficult. So you're also trying to find managers that aren't really attenuating all of their strategies to March 2020 because the future battle is not going to look like the past.
Right, right, right.
So those are the things you're looking for.
So that's kind of what I went to, because you think about you're placing bets for a specific scenario, and I just wanted to, like, they're all trying to win that game, and sometimes their strategy's not going to work out, and one or two might not. But as long as more numbers of them are doing well, you're going to get that payoff, right? And the worst thing that you can do is choose a single manager, and just hope that they're not the one with the sixth bullet on the
Yeah.
gun.
Yeah. Yeah, nice callback. But yeah, you hope it was the one that was up 35 instead of the one that was down 25. So you can look like a
Right.
hero or zero that way. The other thing to like not to get just first order Greeks is like, yeah, we look for, different managers. Managers that are long Vega, managers that are long Gamma, managers that are short Delta. And we think about the combination of those managers. Then we think about paths of moneyness, overlapping those paths of moneyness from at the money, down the money, deep out of the money, all those sorts of things. Are interesting. And then so far in the last 6 months ish, relative value volatility managers are starting to pick back up a little bit. And then tail risk is as cheap as like it's ever been.
Yeah.
It's one of those things again where you're seeing 2017, 2019 levels of buying that tail risk protection. Now, the hard part is just like we were talking about 2010s for commodities versus 2000s is like everybody's still burned from the last 3 years of buying tail risk protection. So now they're getting out of that market, which makes it incredibly cheap now. So this is the thing about just surviving and keeping those line items in the portfolio for when you need them most is really hard to do over longer term periods.
Amen, brother. Well, what a ride, as per usual, Jason. We went all over the place. Thank you for the interview. Thank you for interviewing Adam. Thank you for interviewing me.
Yes,
One day
exactly.
we'll
Yeah.
interview you.
Yeah.
Appreciate your gracious hosting.
Yeah.
Now, what you forgot to ask me is I should just like, just use you guys as a wall. Just keep asking myself questions.
But yeah.
Well, look, it's where can people find you, and tell us a little bit about Mutiny just before we go, where they can find all the information about Mutiny funds.
Yeah, you can find us at mutinyfund.com. That's singular. And Twitter, I'm at Jason C. Buck on Twitter, and my partner's at Taylor Pearson Me on Twitter. We also have at Mutiny Fund on Twitter as well. So everything Mutiny Fund, Cockroach Fund, that's where you can usually find us.
And I gotta say, like, you guys are very close to winning the best website design and logo out of all the asset management firms out there. So if you guys haven't checked it out, if you just want to check out good design and forget about the strategies, go to mutinyfunds.com. You will be blown away. Well done. All right. Thanks, Jason. Really
Thanks,
appreciate your
guys.
time.
Appreciate you
Thank
having me.
you. Yeah.
Sorry to interrupt, but I did want to take a quick second to remind our listeners that the team works really hard on these podcasts. We spent a lot of hours trying to get the right guests, and we do a lot of prep work to make sure that we're asking the right questions. So if you do have a second, just do hit that subscribe button, hit that like button, and share with friends if you find what we're doing useful. Thanks again.